Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about ZOOMLION Heavy Industry Science and Technology Co. Limited Annual Report. ZOOMLION Heavy Industry Science and Technology Co. Limited offers a wide range of businesses and services across various industries. The company's product portfolio includes heavy machinery such as excavators, loaders, cranes, and hoists for construction and infrastructure development. In addition to its machinery offerings, ZOOMLION also provides equipment for the mining industry, including dump trucks and crushing/mesh substations. The company's products are not limited to construction and mining. It also offers specialized vehicles for firefighting, rescue operations, and emergency services. ZOOMLION's product range extends to agricultural machinery, including tractors, balers, dryers, and harvesters. The company also provides equipment for drilling and excavation, such as rotary and horizontal directional drilling rigs and underground diaphragm wall hydraulic grabs. Furthermore, ZOOMLION offers a variety of services, including inspection, client training, and machine maintenance. Its expertise spans multiple industries, making it a comprehensive provider of heavy machinery and related services. ZOOMLION Heavy Industry Science and Technology Co. Limited, market capitalization of $91 billion, is significantly larger than the average industry peer of roughly $13 billion. This shows that ZOOMLION Heavy Industry Science and Technology Co. Limited holds a significant advantage in their industry. ZOOMLION Heavy Industry Science and Technology Co. Limited trades at a higher price-to-earnings ratio of 14 times and a higher price-to-book ratio of 1.15 times relative within the industry. This makes the stock appear much more overvalued compared to its peers. However, the broader industry is also trading at elevated valuation levels, suggesting sector-wide optimism rather than company-specific overvalue. Investor should evaluate if the stock is worth its premium price. The leverage on the balance sheet appears elevated, with liabilities of 55% of total assets. This raises some concern, and we should examine the industry and nature of the business to determine whether they justify the elevated leverage. Liabilities have grown faster than assets and equity, which is somewhat concerning. However, asset growth remains positive, suggesting management may be temporarily leveraging liabilities to fund expansion. Shareholder equity has expanded consistently over the past 5 years, with growth supported by rising operating income. This suggests the company is profitable and financially sustainable. The company has consistently reduced its share count, while revenue and equity have grown, indicating disciplined buybacks that enhance long-term per-share value. The company have a dividend yield of 6.3%. The income statement shows that the company have been growing its revenue annually, and the operating income have been increasing. This shows that the business model works and the business is expanding. The primary drivers of revenue growth for the company can be attributed to several key factors. Firstly, the construction machinery segment experienced a significant increase in revenue, with a growth rate of 15.6%. This was followed closely by the concrete machinery and crane machinery segments, which saw growth rates of 25.6% and 12.7%, respectively. The earthworking machinery segment also witnessed a substantial increase in revenue, with a growth rate of 45.8%. In addition to these sector-specific growth drivers, the company's expansion into new markets and industries played a significant role in its revenue growth. The company reported a 31.4% increase in revenue from external customers outside the PRC, indicating a strong presence in international markets. Furthermore, the establishment of an efficient global sales and service network, as well as the development of new products and technologies, contributed to the company's revenue growth. The company's diversification into emerging industries, such as embodied intelligent robots, also drove revenue growth. The optimization of resource allocation for core products, overseas transformation and export sales volume increase, and the expansion into new markets were other key drivers of revenue growth. In contrast, there are no significant primary drivers of revenue decline mentioned in the report. However, it is noted that a decrease in unearned finance income and a reduction in trade receivables over 3 years, but less than 5 years, contributed to a minor decline in revenue. The net income of the company experienced a significant increase, with a growth rate of 14.05% from RMB 12,810 million to RMB 14,610 million over the period. This upward trend continued year over year, with an even more substantial increase of 35.73%. However, despite this notable improvement in net income, the profit margins showed a slight decline, decreasing from 28.17% to 28.04%. The reason for this discrepancy is not explicitly stated, but it may be attributed to various factors such as changes in operating costs or revenue composition. The company's financial performance indicates a strong ability to generate cash flow. The operating cash flow for both 2025 and 2024 was positive, with values of 23,119 million RMB and 19,491 million RMB respectively. This suggests that the company is successfully managing its operations to produce a surplus in cash. Furthermore, the net cash generated from operating activities in 2024 was RMB 4,573 million, providing additional evidence of the company's positive operating cash flow. The company's debt level has seen a notable increase over the past period. The total debt, comprising loans and borrowings, rose from 10,837 million RMB to 10,962 million RMB, representing an increase of plus 44.7%. This significant growth in debt is accompanied by a substantial rise in interest expenses. The interest expenses have also undergone a considerable change. While the company's total interest expenses were RMB 596 million in 2025, the interest on loans and borrowings increased from RMB 651 million to RMB 711 million. Furthermore, the net finance costs skyrocketed from RMB 28 million to RMB 133 million, indicating a substantial increase in interest expenses. These changes suggest that the company's financial situation has become more burdensome due to its rising debt level and increasing interest expenses. The company's performance varied across different regions and segments in 2025. On the positive side, the construction machinery segment showed improvement over the previous year, while the mining machinery segment achieved significant growth in both competitiveness and market share. The domestic business in mining machinery also experienced countertrend growth, with a notable surge in sales revenue in overseas mining markets. The emerging business segments were another bright spot, with emergency equipment achieving countertrend growth in the domestic market and making breakthroughs in overseas markets. Foundation construction successfully penetrated high-end markets in Europe and America, establishing a leading position in certain regional markets. The mature domestic business segments also performed well. However, not all segments fared equally well. The agricultural machinery segment struggled, performing poorly compared to 2024. Additionally, the emerging business segments experienced poor performance due to a focus on risk prevention and control. The management's outlook for the company is optimistic, as they anticipate a significant focus on high-quality development in 2026. This shift in strategy is driven by government policies and industry trends, indicating a favorable business environment. Furthermore, the domestic construction machinery market is expected to experience an upward trajectory, while exports of construction machinery are projected to maintain strong momentum. The company has a history of paying dividends to its shareholders. In recent years, it has declared significant cash dividends, including a final cash dividend of RMB 12,595 million for the year 2024 and an interim cash dividend of RMB 1,729 million for the year 2025. Furthermore, the company has proposed a final dividend of RMB 1,730 million for the year 2025. This demonstrates its commitment to rewarding shareholders through regular dividend payments. On the other hand, the company has not engaged in share buybacks. Despite its strong financial performance and cash reserves, it has chosen not to repurchase shares from the market. This suggests that management is focused on investing in growth initiatives rather than returning capital to shareholders through share buybacks. Concerns have been raised regarding inventory buildup, a pressing issue that warrants attention. The problem of excessive stockpiling is not limited to any particular industry or sector, but rather affects various aspects of the supply chain. One of the primary concerns surrounding inventory buildup is its potential impact on cash flow and liquidity. When companies hold onto excess inventory for extended periods, it can tie up significant amounts of capital that could be better utilized elsewhere in the business. This can lead to reduced flexibility and increased financial risk. Furthermore, inventory buildup can also disrupt supply chains by creating bottlenecks and inefficiencies. Excess stockpiling can lead to overproduction, which in turn can result in waste and unnecessary costs. Additionally, it can also cause delays in getting products to market, ultimately affecting customer satisfaction and loyalty. In conclusion, the issue of inventory buildup is a complex one that requires careful consideration and management. Companies must strike a balance between meeting demand and avoiding excess stockpiling, ensuring that their supply chains remain efficient and effective. That concludes the financial summary for ZOOMLION Heavy Industry Science and Technology Co. Limited. Feel free to comment below, and I will be happy to answer them when possible.